Good afternoon, morning, evening, and welcome to today's session of Emergence Global. I'm Hugo Dupont, and I'll be your host for today's session of Emergence Global. For today's session, we have a very exciting lineup. First, we will start off with 3 pitch presentations from our own very own ecosystem. We then have the privilege of welcoming our first panel session of Emergence Global, our Fintech Panel, followed by our SaaS Panel. So to just kickstart today's session, I'd like to welcome Kevin Dutta Gupta, the founder of Investify, to present his company. Investify is a post-seed fintech cloud-based software with a global vision seeking 2 million New Zealand dollars by way of convertible note instrument with a coupon of 7.5% to add additional powerful features and scale international operations. So without further ado, Kevin, please.
Hi, my name is Kevin. I'm a licensed financial advisor and one of the founders of Investify, an AI-powered insights as a service platform for the wealth management industry that helps to find undervalued companies in a matter of minutes. Our vision is to become the best end-to-end wealth management platform in the world with the help of artificial intelligence and big data analysis. In the last few years, technology has transformed the wealth industry rapidly in the form of robo-advisors and micro-investing apps. Innovative companies are threatening the existence of the human advisor. However, while these new solutions are very price competitive, they do not do a good job in providing robust guidance to the investor as to what to invest in. As a result, the investor is left with 2 choices: either to do their own research, which takes a significant amount of time and they may not have the expertise, or seek professional advice, which is expensive due to their own time required and compliance costs. This is where Investify comes in with the hybrid robo-advisory solution with the B2B2C model. With the smart combination of AI and data aggregation algorithms, we have created a tool which helps to find undervalued companies in minutes, reach through lengthy documents quickly, creating concise, simplified information through automation, thereby replacing human-intensive labor and increasing the advisor's bottom line profit. In our future roadmap, our solution will help the SME advisor become 5 times more efficient in creating better performing curated model portfolio by reducing the time and cost of analysis by up to 80% and create thematic portfolios such as green energy with the help of AI and big data analysis. Following our initial R&D funded by the New Zealand government, we developed version 1 of the tool. We already have paying customers and collected significant amount of user feedback and considerable interest to enhance functionalities with ETFs, managed funds, and the creation of thematic portfolios to develop version 2 primarily into a hybrid robo-advisory solution. This is the reason for a capital raise. The global wealth management market size was valued over $1 trillion in 2020 and is projected to reach over $3 trillion by 2030. In the previous slide, I mentioned our research has identified a gap in our current version of Investify of not having data for ETFs and managed funds. In the initial 3 markets of Australia, New Zealand, and the UK we have researched, there are 17,000 advisory business with over 57,000 advisors. Feedback from our research was positive if the tool was enhanced, so we believe with the large size of the total addressable market, the opportunity is huge. We have already established a strong connection with financial advisor associations and the Share Broker Association in New Zealand and Australia. We will showcase our solution through different industry events to onboard users and also look to tie up with other service providers such as brokerage houses and financial software companies in the industry to scale our solution. 2 of our team members are licensed financial advisors and have a deep understanding of the gap in the market. My other founder is a seasoned expert in AI, machine learning, big data, and data analytics. We already have a person in the UK in a BDM role, and we're in final discussions with a senior industry participant for a similar role based in Australia. We're looking to raise AUD 1.85 million by way of convertible notes. The notes have a coupon paid quarterly in areas of 7.5%, leading to an equity stake in Investify Limited with an uplift on conversion of 20%. The proceeds will primarily go towards version 2 of the tool, the hires and targeted sales and marketing. We are exhibiting at Emergence 23 and would be very pleased to show you a demonstration of Investify's powerful features, what it can do, and its potential to disrupt the wealth management industry. Thank you.
Thank you, Kevin and Investify. If you are already using the CRIISP platform, please make sure to head on over to the networking zone to message Kevin. If you are joining us on YouTube, please use the link in the description to sign up for free. We will be back in 3 minutes to welcome our second pitch of the day, Fennech Financial Limited and Max Pell, who's their Executive Board Director. All right, thanks for waiting. I now have the pleasure of inviting Max Pell, Executive Board Director of Fennech Financial Limited. Fennech provides a next-gen banking platform as a service for financial intermediaries and corporates, helping organizations to manage multiple banking relationships and orchestrate large-scale and complex processes in payments, finance, and treasury. So I'd like to welcome Max to give a short presentation on that.
Thank you, Hugo. Hello, everybody, and thanks very much for taking part in the pitch session today. The pitch I'm going to give now normally takes between 10 to 12 minutes. Because I've got an 8-minute slot, I've actually taken out a few of the slides. So I've taken out a market slide, competition, and the detailed financials. If you want to see the full pitch, if you go to our CRIISP data room, there's a video of me doing the full pitch. If what I tell you now whets your appetite. So I'm here today to tell you about Fennech Financial Limited. We've created a brand new next generation banking platform for corporates and financial services that have to deal and manage with multiple banking partners. So the challenge today in corporate and transaction banking is, unlike retail banking, it's still very much in the kind of 90s and 100s. The information is shared primarily by PDF and Excel. There's very little true digital relationships. And most of our clients are large international corporates, and they will have multiple banking relationships. And all of those core banks will be trying to offer to our clients the same set of services, whether that be FX management, liquidity management, cash forecasting. And the challenge for the corporate is that not only is this not a digital experience, but none of these banks' systems are interoperable. So I can't use systems that I use with HSBC and combine them with my JP Morgan. So if you're sitting in the corporate seat or in the kind of financial institution seat, you've got a very complex, fractured ecosystem to deal with, and it's very difficult to manage. And because of that, it makes it expensive to manage. It limits the ability to grow and develop new services, and makes it super hard for the businesses to innovate. Now, this problem has existed for some time, and obviously there are solutions in place, and those solutions are primarily treasury management systems, which effectively sit as a overview of all the different banking partners. So at least you can have a dashboard that gives you an overview of your banking partners. But what it doesn't tend to solve is the interoperability of these systems. So I kind of describe this as a band-aid that sits across the problem, but doesn't solve the core problem. So what we've done effectively is we've created a next generation banking platform for large international corporates and financial institutions that enables them to manage all of their banking relationships and have all of their accounts in one place, orchestrate all their payments and finance and treasury operations in one place, and very quickly build new solutions using low code. So what we've done today is effectively taken all the technology and capability that would normally sit within the bank, extract that from the installed bank software, and built that as a brand new banking platform in the cloud, which allows our customers to put all the processing power and manage all of their accounts on one single place. So let's give some flesh to the bones, and let me give you two kind of use cases. And the thing I'd say about the use cases is they may sound very different, but they're all delivered from our same core platform. So we've built a core configurable platform. It's a bit like a workflow platform. We can take the core components and we can make them fit the processes that our clients want to follow, and also fit with the IT ecosystem that they always have. So where our system really stands out is where we have complexity and high volume. That's when the configurability and adaptability of our platform really comes into play. So two kind of core client examples. So Brinks is a US listed, multi-billion revenue, multi-billion dollar market cap cash in transit business based in the US. They wanted to create a new alternative cash network in France to provide an alternative to the traditional network of the banks. And if you wonder why they'd want to do that, that's because although cash is declining as a percentage of transactions, it's still increasing in actual quantum terms. So what we've built for Brinks, plugging into our platform, is effectively a virtual network. And what we do is we connect the tills of all the local tobaccos and convenience stores across the whole of France to create a virtual cash network, which allows people to either withdraw cash or pay bills for their utilities or for buying things online and paying offline across the whole of France. And that network is up and running. It went live some time ago. We're now processing €1 million a month on that network, and we expect to be going to 60 to 70 million euros a year very shortly. In terms of our relationship with Brinks, since that first contract, we've won 9 further contracts with Brinks. So we've taken Brinks from 0 revenue to being a €2 million customer within 18 months. With PaySafe is a large multinational payment institution. They have multiple trading units across the globe. And the challenge that PaySafe had was that they weren't maximizing their FX because each unit of that business was managing their own FX locally. So what we're building for PaySafe is a simple centralized FX hub, which allows all the business units to come and choose the best payment rates from their up to 30 banking partners. And they can do that on an individual level, or they can do that on a mass level. And we do all the reconciliation and commissions and segregations of cash. So it really gives central control to the central treasury function and means they can earn more money from their FX transactions. In addition, since PaySafe asked us to build that, they've given us another major contract. So it's another good example of a client going from zero to being a £1 million contract for us in 12 months. So how does our kind of commercials work? We're effectively a SaaS business, but we're an enterprise SaaS business. So we have 30% of our revenues. They come from configuration and implementation. The heaviest part of that is not the configuration of the platform, it's the implementation into our clients' ERP systems and the banking rails. And then 70% of our revenues are high margin annual recurring revenues. All our revenues are paid in advance, and all of our contracts are multi-year. So none of our contracts are less than 3 years. And the bottom right here, you can see the kind of land and expand, where we started with the initial contracts in terms of annual recurring revenue and where we've managed to grow that revenue over time. In terms of our traction, we're at just about 600K now, average recurring revenue across 12 contracts. We've got just under 3 million in total contract value, and we've got some very big deals in the pipeline at the moment that we expect to close over the next 6 months or so. In terms of the exec team, it's a very senior management team. So all of the team have deep expertise in corporate transaction banking. Our CEO had some very senior roles at both Deutsche Bank. He was a global head of cash management at UniCredit, and all the rest of the team have long experience in terms of running large teams and large businesses. I myself run very large businesses for Capita and for exchanging. And so we've got a very strong team that's very capable of scaling this business. So where we are, this is, we've effectively bootstrapped the business to date. We've only raised 500K through 2 small rounds with friends and family and angels. And this is our first institutional round. So we're looking for 3 million, and most of that cash is to be spent on helping us to scale up the business so that we can onboard multiple customers simultaneously. We already have sight of that 3 million. So we have a UK tier 1 bank that is leading the round, already committed 2 million, and we're just completing their DD. We have sight of the remaining million. We're not closing the round at 3 million, so we're still open for additional investment. And for UK taxpayers, we qualify for EIS, so that makes it very attractive. So we're still looking for another 500,000 or 1 million potentially to close this round out. So that's it. There's a lot more detail on the CRIISP platform, including the financials and the market size and the things that I talked about. You can contact me via the site, and we'll be delighted to have a conversation with you. So thank you very much.
Thank you very much, Max. Great. And as Max said, if you guys are watching this from the CRIISP platform, if you head on over to the exhibitor tab on the Emergence Global and just type Fennech, you'll be able to connect with Max. And if you guys are watching from YouTube, then there's a sign up link for free in the job description. So feel free to sign up there and head on over to Fennech Financial Limited's room. Now, I'd like to invite our final pitch session of the day before we head on to our Fintech panel. I'd like to welcome Geronimo. He is the co-founder and CEO of Bildia. Bildia is a SaaS-enabled construction trading network that streamlines procurement for builders and suppliers. They save 60% in operational costs and provide 100% real-time data about the most critical business process for their industry, which amounts to about 8 trillion euros per year. Geronimo?
Yeah, thank you, Hugo. Good afternoon, everyone. I'm Geronimo, CEO of Bildia. What we are specialized in is digitalizing the supply chain for this massive industry of construction and helping builders and manufacturers build a smart way. So if you think about it, compared to any other industry of manufacturing, we are very special. We're an industry of prototypes. And I think this image speaks for itself. Buildings always have to adapt to their context. That means they're different from each other, regardless of the level of industrialization that we bring in. That has a massive impact on our industry. It makes construction supply chain critical because it is project dependent, which means that you have to practically reboot it from scratch on every project. And it's ever changing as a result of that. To give you three key facts, it is the number one expense in construction. If you leave aside the cost of land, costing more than or north than 65% of the total investment of a project directly in product, services, and systems contracting. It is the number one factor and process in the business to boost the net profit of general contractors, since it's so deeply integrated with their investment and their daily operations and their business model. And if we look at the impact of construction into sustainability, the lack of digitalization of this supply chain is the number one blocker to trace and reduce embodied CO2 emissions, which account for 50% of the total industry emissions and 20% or around 20% of the total global CO2 emissions only in this industry if we look at it at large. So it's a massive, massive impact. Only in procurement or supply chain of products, systems, and services, we're speaking about an 8 trillion euro market globally with problems that are the same size of the market, so massive. And we have some shared general level problems and then specifics for the two key agents we're working with at the moment for general contractors and manufacturers. They have fragmented, repetitive, and non-traceable contracting and sales processes that waste up to 60% of time in many of the cases, that generate losses of problems in 10% of the cost comparative to their volume of sales and of contracting, and nearly 100% of the data collection is lost. That means that if you ask a relatively sophisticated general contractor or manufacturer, medium to even big, about what is the repercussion of certain trades in a project or of certain recurrency of a client, they have a hard time and they need to spend a lot of time to really get to that data. So it's not intricated or it's not included in the operations of their business, nor adding any value for decision making. On a day-to-day of a general contractor, estimations and procurement happen with thousands of emails and calls, scattered conversations across the different departments and site managers. There's absolutely no procurement traceability in real time, so no data collection and decision making. And as a result of that, one of the critical areas of business development, which is getting into new tenders from clients, is very hindered. It's impossible to estimate the costs fast and then offer or participate in those tenders accurately, which impacts a lot their capacity to drive that profit by optimizing their procurement. On a normal day on a B2B sales manufacturer, it's again hundreds or thousands of emails and calls from different clients, distributors, all of them B2B, asking for prices that are not updated in real time, scattered conversations across offline and online commercial teams, no client traceability, incapacity to predict what they need, and hence develop or produce, and problems on stock based on that. And in the end, it's really impossible to automate price, rappel, and discounts, hence grow commercially. What we have built is a supply chain software and ecosystem of construction. So we streamline those supply operations, that data collection, and that traceability between builders and their network of subcontractors on the one hand, and manufacturers and their networks of resellers and B2B clients on the other hand. We operate on a digital system that is a SaaS-enabled marketplace or market network, whereby we have different vertical SaaS. In one case, one vertical SaaS for procurement and another vertical SaaS for B2B sales and management. That can also connect to a larger network of external companies that we're progressively indexing and adding from the networks of our different clients. And we have a number of other functionalities for marketing, for market, direct trading, and contracting. I'll give you a very quick overview of one of the parts of the platform, in this case, the one dealing with general contractor, more for the look and feel. Of course, if you're interested, we have many more information on the CRIISP platform, and we're happy to share specific demos of technical functionalities. What's important to say is that on Bildia, every company is a unified operations and data hub where the whole team from all the different departments on the supply chain, or both from the side of procurement or sales, are integrated, where the different engineers have different environments across the life cycle of the product, from the initial estimations to procurement once a contract has been awarded, to subcontractor management during the life cycle of the construction process, and then further down the road with the asset management even. And then all the data is integrated. Then they can create projects very fast, add all sorts of data related to the contracting conditions, technical conditions, VOQs, any type of data that might be needed for interacting with direct trades. And then they can onboard all types of users with different levels of privacy and start generating multiple procurement operations and tracing that in real time. This is a very visual component, or the introduction to the project, but then inside the platform, you can manage it in a much more, let's say, data-oriented way. Then we have very different functionalities for all the types of engineers that happen across the line, or that take place across the line. This is just a glimpse of, for instance, the bid leveling engine, where you can integrate data from different sources of subcontractors, both from inside the platform, subcontractors that are answering from the Bildia platform, the trusted subcontractors of our clients that are answering within their private networks through the system of Bildia, or even from outside offers that can be input here by the engineers, making a unified and ever-growing ecosystem of data where they can benchmark that against different KPIs or against different business indicators, such as the average budget, the offer budget, and many other things. And then in the end, we can generate a business intelligence center with all these data gathering, with all sorts of configurations for the specifics of the business model of our client. What's very important is that we not only build that based on the data that they generate on Bildia, but we can also onboard the data from previous projects. So make a project of implementation where from moment zero, the platform is adding a lot of value. So if this was a timeline, on the left, you would see previous projects, and then also further projects nurture this engine of value, and where a number of applications of AI for estimations and procurement are taking place. Our business model, we start with a procurement SaaS for the builders, where they bring their private networks of subcontractors. Then we're starting now with B2B e-commerce SaaS for manufacturers, where we charge an implementation fee plus a SaaS fee, and then not a transactional fee exactly, but like a percentage or a variable fee based on the volume of operations that our platform enables. And we are ramping that up to be within 5 years, around 80% of the commercial volume of our key manufacturers through that platform. We allow access for free to their clients, resellers, service professionals, builders. And then in the meantime, we're building the intermediate pieces so that all these private company networks can end up connecting to a centralized market. With all that unified, we will be able to provide financial interest services and construction-specific delivery logistics, which are a long-term problem based on the specifics of our industry. It's quite easy to, with this strategy, to consolidate a market which has one of the key challenges in its fragmentation. So we come from the left with if this curve represents the distribution of type of number of companies. On the left, we have general contractors. In light blue, we have their subcontractor categories that we integrate. And at the moment, we have 6,000 subcontractors that have been brought by around 10 general contractors, 10 to 15. And then on the right, we do exactly the same operations from manufacturers and networks of subcontractors or resellers that can be up to 400 companies per client. So in the meantime, we are building a series of automations to bring the intermediate piece and connect all these private networks with our own network of subcontractors, resellers, and so on. Where we are in terms of traction, we have 12 fully implemented general contractors for a purchasing power of 150 million on Bildia, starting work now with 3 major manufacturers in Spain in March. We're starting to collaborate on R&D and carbon tracing in supply chain with top-tier globally construction companies like FCC, Skanska, and so on, and with some top-tier manufacturers like Finsa, one of the largest wood manufacturers in the world. All our clients are paying customers, so we work with full integration once we start, and we have at the moment 350 procurement operations active and 50 million in projects construction budget there. We're on a round size of 1.5 million plus 200k in public funding, which we have been already granted. We already closed 500k, and we are in advanced conversations with different investors to close at available 1 million, hoping to be able to have the firm commitments by the end of Q1 2023. With that, we will reach 50 fully implemented builders and their networks, 20 big manufacturers and their networks, 50,000 subcontractors certified, and about a billion in procurement power on Bildia. In short, we're a team of founding teams. We're a founding team with a lot of experience in construction technology and sales. Among others, we've been working on public projects in 5 different countries, and we've managed technology projects such as a marketplace of Leroy Merlin that was launched in Europe recently. We would love to speak to you and join us on this amazing journey to build this supply chain software and ecosystem for construction. Thank you.
Thank you very much, Geronimo. As I've mentioned beforehand, if you're just joining us from the CRIISP platform, please make sure to connect with the 3 founders who have joined us this evening via the networking zone. If you are joining us from YouTube, please find the link in the description to join us for free and have the possibility to network with 1,400 attendees and growing, and to connect with the founders making a difference. We will be back in just a moment with our FinTech panel. So thank you and welcome back to today's Emergence Global session. I'm very excited to welcome you to our FinTech panel this evening. We are joined by 3 brilliant people, Shamir Sekdev, founder and managing director at Growth Gorilla, Alexandra Piedrahita, principal at QED Investors, and Nick Jones, co-founder and CEO at Zumo Money. Welcome, guys.
Hi.
Would you like to each introduce yourself? Perhaps Shamir, you could go first.
As Hugo mentioned, I'm MD and founder at Growth Gorilla. We're a growth marketing agency. We specialize in the fintech sector, working with startups all the way to scale-ups. Our areas of sort of our specialties are developing go-to-market strategy, market entry, and product launches.
Great. Thank you. Nick?
Yeah, thanks, Hugo. Yeah, so Nick Jones, I'm the CEO and one of the two co-founders of Zumo. So we're a fintech based here in the UK, blockchain specific, digital assets focused fintech. Historically, we've had a direct to consumer proposition, which we decided to pivot into a B2B focused proposition at the start of last year. So we've been busy doing that over the course of last year, now providing a digital assets as a service proposition to large financial institutions, banks, fintech apps across globally.
Cool. And Alex?
Yeah, so as Hugo mentioned, I'm a principal with QED. QED is a global fintech-focused venture capital fund. We were founded about 15 years ago by Nigel Morris, who is an Englishman but has been in the States for about 4 decades and founded and built Capital One. So Capital One is now sort of a top 10 bank in the States, but was originally, in many senses, the first challenger bank. And we as QED invest predominantly in seed and Series A fintech around the world.
Brilliant. Thanks, guys, for being on the panel today. So I guess we'll just jump straight in, and perhaps this is a question for you, Alex, and then it'd be great to get your opinions, Nick and Shamir. But what role do you see fintech playing in shaping the future of finance and commerce? And how do you envision it evolving in the coming years? We've seen its first big boom until 2021. Last year was a bit slower, but what do you see the future of it being?
Yeah, so I mean, I think that fintech has been sort of the defining feature in financial services and pushing the entire sector forward from an innovation perspective for, well, a few decades, but especially ever since the term fintech kind of really was solidified, which is about 10 years ago only or so. So I think that we're entering the era too where we're going to see a lot more sort of partnerships between sort of fintechs and banks, and or fintechs that are actually powering different products within banks. So banks will still act as sort of distribution channels or sort of balance sheet holders. I mean, I don't think that any of us here in fintech are sort of trying to argue that banks shouldn't exist. I think it's just about what role the bank should have in the future and how fintech can help push the entire industry to get there, and sort of a plug and or tug and a push and tug between sort of the fintechs, the banks, and then the regulators, obviously. So yeah.
Great. Shamir and Nick, do you guys have anything to add to that?
Yeah, I don't disagree at all with Alex's sort of summation. I think embedded solutions are going to be a big part of the future looking forward. I think as we see more sort of data being acquired, there's going to be more personalized solutions. And then I think also to a certain extent, solutions like buy now, pay later will probably also encourage more regulation in platforms. Even areas like crypto will encourage more regulation as well. So I think that will help shape out fintech financial services moving forward.
Great.
Yeah, just to build on that, I agree with everything everyone's said there. I think probably just building what Alex has said, these partnerships with larger financial institutions, which certainly we're seeing, they want to explore Web3, digital assets, crypto. They don't really want to have to come in it from a standing start. And I think that's a really interesting piece. But also more broadly, I think this intersection of kind of fintech, entertainment, large kind of brands out with of kind of traditional FIs looking to get into financial services and offer fintech products. So embedding payments or embedding insurance or embedding crypto into their existing platforms. And I think the big macro that's driving that, and any big events, this whole idea of kind of Web3 tech into Web2 companies to help them make this transition. And I think that's certainly something that we're seeing, that's a massive interest driver in our business at the moment.
Great. Yeah. So, thanks for those. And I guess Shamir, maybe perhaps looking at considering your background, you left a job previously. You striked out, as you said beforehand, to start advising fintech and financial services firms on growth? What really drives you to do that?
What drove me to do that? I think, well, if I'm honest, being fed up of working for somebody else was probably the primary reason. But I think the second thing is just having a background in financial services and then seeing the move from going from sort of very sort of analog to digital. What I mean by that is that when I was sort of client side in my last role, we launched a web trading app, which was quite a big deal. And for me, that kind of gave me the notion that I think that we're going to start seeing a real jump in the tech space in terms of financial services. And it seemed a really good opportunity to try and get into the fintech space where there's a lot more disruption happening. And I felt that's kind of where the world was heading and the money was heading, really.
Cool. Okay. And, since you started Growth Gorilla, can you share maybe some success stories of how you've helped companies go from perhaps startup to scale up? Anything in particular that you see in certain recurring themes?
Yeah, I think so. Look, I think the list is, I wouldn't say necessarily endless, but there's a lot of companies that we've helped, from that startup stage all the way to sort of growth and scaling. We took a crypto trading platform from sort of one territory to about 25 territories across Europe. And that was moving very swimmingly until obviously midway through sort of last year when Bitcoin started to crash. And another company that was disrupting the property sector for first-time home buyers. And that was a really interesting piece there. But I think what's going to be more helpful to the listeners is probably understanding the ingredients that go into these companies that have been successful. And I think really what it boils down to is continuous testing and non-stop testing and experimentation, both from a marketing level, so audiences, messages, creative, etc., channels and whatnot, but also from a product perspective as well. And then I think the second thing is just being really on top of the data that they're accumulating, then using that to make informed decisions. The most successful companies that we've seen are those that have a really, really good infrastructure in place in terms of tracking and data and analytics, again, from the marketing side and then from the product side. And then interpreting that data and then using that to inform how they're developing their product. And then I think the third thing is communicating and talking to their customers, running surveys, speaking to them, on a qualitative level and on a quantitative level. So running surveys, but also then doing in-depth interviews with them, and then extracting that data and then taking out anecdotal information as well, and then leveraging that to make decisions around the business and how to move forward, and then using that to really then underpin their growth. Those would be the core things that I've seen over the years that have define the companies that have done well versus those that haven't really.
Great. Okay, thank you. And I guess, Alex, in your role at QED Investors, what kind of support as well do you provide apart from just investment to the companies that you guys invest in your portfolio company?
Yeah, so support is a huge part of sort of the QED value proposition, and kind of how we win deals, especially when the markets are more competitive. The majority of our team, I am an exception, but like 90% of our team are all ex-fintech operators. So founders, operators, they've been in the business of building fintech, whether it's Capital One or smaller ones in the past. So where we really lean in is in all things fintech. So, most VCs, will be helpful in some way in sort of, helping scale your go-to-market or helping hire the right sort of head of marketing, different things like that. Where we really lean in is on the fintech side of things. So helping make sure that you set up your credit committee correctly, helping make sure that you're sort of crossing your T's and dotting your I's in terms of regulatory, whatever requirements, compliance, KYC, AML, those are all the areas that we tend to sort of lean in on. And obviously, that's both through sort of the operator background of our team, but also in the fact that, we have a portfolio of almost 200 purely fintech companies. So we have 200 other sort of cases and examples of sort of how we've seen companies scale in consumer lending or B2B lending, or cross-border payments, or compliance. So I think there's a lot of sort of pattern recognition and seeing what works in different geos, what doesn't, and sort of applying the best practices to newer up and coming portfolio companies. So yeah, we really lean in on the fintech side.
Okay, that makes sense. Yeah, I was speaking to SaaS investor, solely SaaS focused investor last week, that were saying they were focusing a lot on the SaaS protocols as well. So it's interesting to see the different kinds of investors focusing on different things. So I guess when a company is looking perhaps for investment, in terms of strategic investors, is especially important nowadays with the rise of niches and specialized niches. So I guess, Nick, as a founder now, with Zumo Money, what, Alex talked about the support she gives, but what kind of support do you look for in perhaps an investor or strategic investor, or some of the things like that?
Yeah, it's a good question. I mean, I think investors can add value in a number of different ways. So I think we've been quite fortunate. It's my kind of third time round with this business. So worked with a number of investors who I've worked with previously, who I kind of know what they bring to the table and are kind of known quantities and from my network. But I think now we're in the process of raising our A round at the moment, and for us that real lens is what extra value can an investor bring, and that's a really interesting kind of conversation for us at the moment. So we have I think broadly speaking, as either there's a kind of genuine strategic investment option for us, where we have opportunities with some pretty big kind of global companies to partner with them now on that investment route. But does that limit your kind of exit options going down the road, or do we go down the traditional VC route? Obviously, we have an interesting situation where we're in fintech. We have a background in crypto. What does the kind of traditional VC world think of crypto at the moment? But bearing in mind last year's pretty disastrous, 3 potential black swan events in 6 months. And this actually shows the good resilience in the industry that it's managed to survive. And I think it will probably come out of it a much stronger, better regulated, certainly better governed space, which is kind of our, that's kind of always been our big driver. So I think just it's alignment with investors and realistic expectations. It's the same with hiring people or working with non-execs. As long as you know what you're getting into, or what you're actually expecting somebody to bring. So for us, it's how do we move out of UK European markets? Who can help us support in that, either through large commercial partnerships or through funding and expertise to help us launch. As Alex is saying, how do you navigate the regulatory landscape in a different geography? Who's done that previously in that portfolio? Where's the biggest kind of bang for your buck in terms of that market? So that's what we're weighing up. Really, so just that it's an interesting time to be asking me, because we're sort of weighing up those exact options at the moment.
Okay, and very, very interesting. And I would like to come back to something you touched upon. We've seen a lot of ups and downs when it comes to cryptocurrency, and especially last year we've seen a big down. This has also had an impact on the reputation of blockchain, particularly when it comes to financial transactions. How does Zumo Money, for example, ensure trust in that sense?
It's an interesting one, because I actually would probably disagree with you there. I don't think it has. I think that financial institution adoption of blockchain, DLTs, the technology is carried on regardless. I think there's a definite backtrack or in consumer confidence around crypto. I think that, but I think what's quite interesting is, previously, I'd say the whole world, the sort of the link between Bitcoin and blockchain was inextricably linked. I think for most sort of reasonably well-educated financial institutions now, they draw a line between the two, and you're seeing all sorts of, blockchain or distributed ledger technology being used, particularly in banks, but in asset management, back middle office, processes, foreign exchange, HSBC with their FX Everywhere platform, which is, an atomic swap platform. That, you know, they don't call it an atomic swap platform, but it sits on a distributed ledger. So I think that, and digitization and tokenization of assets, I actually think that, interestingly enough, I think that sped up institutional adoption or interest in blockchain and in tokenization is going very, very quickly. I think institutional adoption and desire to get into crypto has definitely taken a backward step along with consumer confidence. But as soon as there start being lots of outflows from traditional banks to crypto exchanges again in the next bull run, that opinion will change quite quickly, and that's kind of how we see it. But lots of stuff has to happen for it to get better. We need to have better founder behavior, better governance, companies being run properly, probably better investor behavior in terms of what they're encouraging from a kind of a, you know, from the environments that were created with these sort of unrealistic levels of growth that were being that were being kind of fed last year in the market. So I think there's a whole alignment piece there. But yeah, I definitely think it's a really interesting one. I'd say that from our own experience of kind of pivoting into providing infrastructure basically to other FIs, banks, fintechs, there's a big the separation between kind of blockchain and Bitcoin has been made. You just need to call it, you have to call it digital assets now, not crypto, right? And then everybody's okay.
Yeah, okay, that makes sense. And Shamir, I guess considering the number of fintech companies you have advised, perhaps in the past, in your opinion, and touching upon what Nick was just talking about, what regulatory challenges do fintech companies face, or the ones you have encountered, and how can they navigate them efficiently?
What have they faced? I think it's quite a broad question. It depends what area of fintech that they're in. If we're talking about crypto, obviously the biggest issue there is obviously each territory or each country is now starting to regulate crypto, at a country level, and that is then impacting the ability to A, become regulated, and then B, that's impacting the ability to market the product. So it means that companies that are trying to launch now in the crypto space are finding it a lot more harder than perhaps a few years back when there wasn't, when the regulatory landscape was effectively non-existent. In the more broader sense, in terms of other businesses or non-crypto businesses, I think we've kind of got over this hump now. And I think in the UK, we saw that with the FCA sandbox. They didn't really know where or what to do with fintech platforms because sometimes they, straddled grey areas. A good example of that was with Crowdcube and Seeders back 10 years ago, when all of a sudden they were offering investments to retail investors. What could the FCA do about that? And from what I understand, they went and actually opened up a dialogue and had a conversation, and then seeing that it's going to be an area of growth, they then created the sandbox. So I think the biggest challenge is going to be launching into territories or targeting territories that don't have such an infrastructure in place, and then having to then work with the regulator or the local regulators to then come up with some sort of dialogue and the method and way of working. We had a client that was operating out in Indonesia, and they've faced some real sort of struggles out there in trying to launch their platform because the Indonesian government moved quite slowly. It's quite corrupt, and they didn't know they didn't know how to manage that sort of tech and what they were offering. So yeah, I think we moved along, from a regulatory perspective, from where we were a few years back. So I don't think the landscape's as bad.
I could probably chip in on that, Hugo, if it's helpful, because we're one of the 30 odd FCA registered crypto assets firms here in the UK, and kind of registrations in a couple of other EU markets, but keeping a very close eye on the forthcoming MiCA regulations, which will give something like the e-money regime for Europe, allow passporting between countries, unify crypto regulation across those markets. Also, some very good encouraging noises from Treasury here. I think from our point of view, and it's kind of like this is the kind of the end of the Wild West days on crypto. Now it's about being regulatory compliant. It's about understanding consumer duty. It's about understanding what the regulations actually are, the claims that you can make, and trying to ground those and make them as like other financial products as possible to regain consumer trust. So I think, we see the kind of emergence of regulation as a big positive, because ultimately it will be what stops consumers from getting taken to the cleaners and losing all of their money. And I think that is it will provide opportunities over time. It's an adjustment. It's kind of an adjustment in the space, but it's one of those things that has to happen. That doesn't mean that kind of unregulated, non-custodial crypto will always exist as a stand alongside for those who've got the appetite for it. But I think, we've seen from an adoption point of view that most people don't. Most people want something that looks, that they can have another layer of trust and some of the complexity obfuscated in, which is all part of the same conversation. But there's definitely in our space, there's this huge, this is kind of the growing up phase, and some sort of nascent, and some really good news here in the UK in terms of what's happening with the FCA, what's happening with Treasury driving that conversation. We will have within a year a proper regulatory regime for custody, lending, and exchanges in the UK, and that will give us competition, really fair competition, and the chance to then be able to, turn UK, London, Edinburgh into kind of a real hub for this stuff, which is what we all want.
Thank you for that. Ali, I think, Shamir was talking about the kind of the global side of things. And, I feel like with QED investors, you guys have more of a global outlook as well. Do you find that the regulatory landscape, or perhaps, just the regulatory landscape in regards to fintech, is quite different in different regions, or have those regions kind of found a balance?
No, I don't think it's like an even level playing field around the world, for sure. I think, I forget what the exact quote was, but I think it was something along the lines of the US builds first, Europe regulates first. So it's definitely a tougher regulatory environment here. And I think, we're in the early innings when it sort of comes to DeFi and crypto, but even for fintech, where we're a lot more advanced, things are still, evolving all the time. And, we're going through a more conservative or sort of tightening sort of regime right now, even when it comes to sort of, the fintech EMI license and, piggybacking off of partner banks and stuff. So I think it's always going to be evolving. And I think that we as an industry need to do our best to, work with the regulators and bring the regulators forward. And I'd say it's interesting, some of our partners that cover more of the emerging markets, for example, especially I noticed with India, and then with the markets in Africa, so Nigeria, Egypt, Kenya, our partners tend to meet constantly with the regulators there, because the regulators are sort of maturing that market in a time in which fintech, the regulatory sort of regimes at the same time in which fintech is also sort of existing and growing up, whereas most of our regulatory regimes predate fintech. So it's an interesting sort of, environment in some of those emerging markets where they're actually looking to VCs and leading, founders for advice on how to build the best regulatory structure and regime and incentives. And that's just not something that we would really do, here in the UK. So it's interesting. It's not a level playing field. I think Europe is of the tougher places to build. So yeah.
Okay, thanks for that. And I guess this is probably a question for both Shamir and you, Alex, in terms of, and also Nick. But in terms of, considering the number of companies you've helped, are there trends apart from the partnership? Are there trends in the fintech space that are emerging at the minute that maybe the companies you've helped recently? Are there commonalities between them that are emerging? And if so, what are they?
Yeah, so one of the most sort of, I guess, hot trends of fintech. I mean, I'd say like one theme that is just penetrating sort of every corner of fintech, but especially when it comes to payments, is just that more and more so, new companies being formed and scaling and being successful are either global by default, so cross-border by default, and or like platform businesses by default, right? So they have, two different sets of stakeholders that they're sort of working with and sometimes connecting in a marketplace fashion, sometimes connecting from sort of a workflow or a SaaS perspective. So I'd say like there's a whole subset of fintechs that are building for sort of natively global and natively platform type businesses. And the reason why it's kind of interesting and complex, I mean, obviously, fintech is unlike every other sector of tech that the regulatory regimes constrict global, expansion in a way that, for SaaS, it does not, right? Or sometimes for consumer, it does not. Fintechs have this whole other layer that they have to deal with and comply with and think 2, 3, 10 times about before they decide to, go from the UK to the German market and open up shop there for the sake of, growing their product. So when it comes to sort of, payments or banking or lending, there are a lot of companies out there that are trying to help from sort of an infrastructure and a fintech perspective for businesses to deal with their cross-border payments or to deal with the fact that they have accounts all over the world, or that they need to receive money from one country and then disperse it in another, and they need to comply with the local regulations of each and do the KYC AML of each. And the fact that those are going to be distinct requirements on each side, right? So these are huge complexities to deal with and therefore massive opportunities. And I think a lot of the fintech infrastructure that got us to where we are today is helpful and really great, but wasn't necessarily built with those things in mind. So there's an opportunity now in people rethinking how would we build Stripe today or Adyen today if we knew the extent to which these businesses needed to be local and global. So yeah.
Thanks. Shamir, did you have anything else to add to that? Or
to be honest, I was going to say, I think Alex kind of covered that really well. I think, I'll probably surmise that as there's probably going to, the big trends seem to be a lot more investment into what I call the piping platforms like Stitch and other such entities that are making connectivity easier. And I think the other thing, just from a perhaps more of an audience perspective, the other trend that I've seen a lot over the last 12 months is propositions that are focused more towards communities. So, for example, neobanks that are focusing on specific areas of the market. In the US, you've got Bank Greenwood that's focusing on the Black and Latin market. Here in the UK, you've got Algebra that's focusing, they don't say on the Sharia market, but they pretty much are. That's become quite a commonality as well. So I think we're going to continue to see a little bit more of that. I think the restriction that they're going to have is going to be that question around regulation and whether or not the market's big enough in the territory that they're launching in, and then therefore how quickly do they need to expand in order to make their proposition viable.
Okay, great. Nick, I actually just received a question from someone via email. So, the question is, with the increasing popularity of decentralized finance, what impact do you see it having on traditional finance institutions, and how can they adapt to this changing landscape? And perhaps if you could talk maybe about Zumo as well in there.
Yeah, sure. I mean, look, I think that as an area that has taken that people have decided to take a pause on or a deep breath and wait and see what happens there, that is definitely one. I think the Celsius blow up last year was kind of pretty damaging because it was a marketplace with no real controls on either side, a loan marketplace with no controls on either side, huge amounts of money being poured into it, and just not the right kind of structure around it to make that work properly. And I think it has, although you'd argue that was the issue there was it wasn't a true DeFi marketplace. It was tapping into kind of DeFi principles, but it was being controlled very badly centrally. I think that has really put the frighteners on a lot of institutions around DeFi, but I don't think it and certainly with users, a lot of people obviously lost out very badly on whether on any one of those kind of too good to be true looking issues that we had at the end of last year. So I think there's been a big knock around that. I don't think it destroys the principle or the potential of DeFi to disrupt lending and both sides of that lending place. So kind of investing / lending, yielding. I think that's still a really sound principle that people really, really like. Alex mentioned emerging markets. Certainly makes massive sense in emerging markets for the DeFi piece where there isn't the kind of traditional banking system in place. There aren't the same type of lenders. It's not as easy for people to borrow. It's not as easy for people to prove who they say they are or to access banking. I think there's a massive. My personal belief is that the real potential for DeFi from a consumer perspective lies out with kind of Western Europe, the US. I think that actually in terms of impact, it has a much greater potential for impact in emerging markets and emerging economies, and I think that will come back. In fact, I think probably underlying activity in markets where there is a very strong level of where there's a strong interest in the space hasn't really gone away. So you look at I know everybody always says Nigerian market, but these markets are still kind of booming. People are still using them because it is a genuine alternative to traditional banking. Maybe in Western Europe it was a bit of a nice to have or for people to kind of play with on the side because they weren't getting anything from their supposedly interest-bearing savings account, which they never had any interest from, or they're losing money because inflation's running at 9%, whatever it is, and they're getting 0.1% on their banking. So that the potential is strong. As with all of this stuff, I think that we've either got to have genuine decentralization, which prevents kind of fraud and loss of control. So genuine in decentralization. But how do you make that palatable and understandable for most people to access? And that will always be the issue with genuine full decentralization. It's the paradise, but how do you get there with making it usable? Because for most people, even putting funds onto MetaMask is pretty terrifying, and sending it to a DAO, or it's so easy to get something wrong, and to it's like that's a huge challenge. How do you obfuscate that and keep decentralization and keep the trustless piece as the way of regulating it? And then on the other side, if that's not going to be the case and it has to have a CeFi element for most users to be able to use it, how do you have governance in place to stop it from running away or being manipulated by bad actors, or just having no governance around it to keep it kind of contained? And those are the two things that will have to be answered for it to really realize its potential. For it to realize its potential, can you make it usable as a decentralized piece, and can you have good enough actors in there running governance? And I think you're starting to see beginning to kind of spin its wheels up again, because it as a concept, people being able to borrow money from other people rather than from an institution, and being able to earn a bit of money for doing that, and for you to be able to borrow at a fair rate. Everybody likes that idea. It's just doing it in a way that has some rules and some best practice around it.
Cool, thanks. I guess I think Ali, earlier you touched upon the word disruption, and I guess how does QED investors balance the need for innovation and disruption with the need for stability and security in the financial industry? I think you're on mute. Yeah.
That's an interesting question. Let's see, how do I think about it? I mean, the most, I don't know, in terms of sort of what we're investing in the companies, I mean, we invest in both consumer propositions as well as sort of B2B. And I think, yeah, I think when, like, if a consumer sort of fintech proposition kind of goes under or blows up or fails in some senses, I think the ramifications can be larger than just sort of your average app or your average tech company, you know, going under, obviously, because a financial, whatever, a fintech will either be holding your money, or it's a brand and an app that you trusted to move and touch your money in some way, right? So I think we're always hyper careful about kind of the levels of growth that we encourage or like to see, and making sure that there are never levels of growth that are going to break the system, right, and potentially bring it down. And therefore, like, growth, yeah, it just doesn't have the same KPI. It doesn't have the same sort of power of a KPI, I think, for us, especially in fintech, than it might in other sectors, because too much growth may not be a good thing, especially like if you look at lending, right? It's really easy to like scale a loan book, and to you know, where to make a bunch of loans if you're going to offer a quote better price. But that might really come back to haunt you, because it's very easy to lend money. It's harder to, you know, collect that money. So I think it's something that we sort of look at with a very balanced approach, and always have. And I think a lot of the market, you know, during the hype market of sort of 2019 to 2021, there was a lot of non-fintech specialists that got into the market and looked at sort of fintech companies through the same eyes that they looked at sort of SaaS and other areas of tech. And I think that led to some not ideal sort of practices and KPIs and growth metrics that I think companies were going after. And we really struggled with that during that market hype, because we sort of would sit on these boards and disagree with a lot of the other investors around the table in terms of what companies should be optimizing for. But I think that the market has normalized and corrected significantly, and unit economics matter again, and sort of healthy growth and the right burn multiple. So how much are you burning for, you know, new ARR that you're bringing in, has become sort of part of, you know, general discourse again. And also a lot of the sort of more tourist investors, whether they were growth stage generalists that were coming in and doing Series A's in fintech, are no longer here, and so aren't sort of pushing those same dynamics that they were before. So I think those are all healthy things for the market. Yeah.
Okay, great. Thanks for that. And I guess Shamir as well. And you know, when you help companies go from probably you know, to scale mode, what is it that you look for in a company, or how do you change something or provide them with advice to get to that stage? What would be like a few advice you would give them to get to that stage?
Yeah, I kind of touched upon it earlier, which was about the tracking and data and analytics, and that's probably one of the key areas. Just being really focused on tracking the numbers and being on top of that. I think one of the biggest mistakes we see is sticking some activity live and then kind of hoping for the best, or not being really clear on what their value proposition is or who they're targeting, and you know, ultimately not being clear on what they're trying to achieve. Kind of all of those things, you know, if I kind of see that, then they're all sort of red flags, and we try and help our clients sort of nail those bits down. But I think more recently, I think the advice that I've been giving is that we always talk about product market fit. I think it's been pretty easy over the last sort of 10 years or so, in the sense that there's a lot of focus on the product part of product market fit, and you've got a lot of companies that got caught naked when the tide went out, when the market changed, because their product no longer fitted the current market, and that had been completely forgotten about. So I think one learning for me is in some of the advice I'm giving is don't forget about the changing the market landscape. We don't know at this stage whether or not to be a pessimist here. We don't know if it's going to, the market's going to get any worse here, and how will your product stand up if the market takes a serious downturn? And then equally as well, on the other side of that, if the markets start looking really ripe again and they start to move up, will your product then still be relevant? For example, lending products may not be as desired, if money starts flowing a little bit more freely again. So yeah, but in a nutshell, my advice is keep an eye on the data, be mindful of product and market, and track absolutely everything, and then ask yourself, are you really, really clear on your proposition, and are you really, really clear on your audience? And then just be mindful of keeping an eye on those numbers. Does it make sense to pay X amount for a user? Or are you growing are you growing for the sake of growing, or are you growing because you're building a viable business?
Okay, thank you very much for that.
There, yeah.
No problem. Nick, Zumo's mission is to bring the benefits of blockchain and digital assets to people and businesses everywhere. What do you think is the biggest barrier, or perhaps multiple barriers, that you could think of that is needed to achieve perhaps mass adoption of those technologies?
Yeah, so look, I mean, one of the reasons that's interesting listening to Shamir talking, then it's quite, one of the reasons why we've pivoted is because that we believe that, interesting to Alex and Shamir talking, actually, because when we were raising money in 2021, and we kind of got sight on what good supposedly looked like for some of the maybe tourist VCs that were investing in the space at the time, in terms of what good looked like from an ARPU point of view for users. And it became pretty clear to us that something was going on at some of the firms that we were being told we were way off the pace with, from a revenue generation point of view. And now we know what it was that was going on. There's lots of dodgy stuff going on with people's money being gambled and used for nefarious purposes. And so, that was a big driver into us, like going back to the B2B piece, really trying to understand where we would get that product market fit, and where the opportunity was. So one of the drivers for us was that the next big wave of adoption in this space will be with household name brands attached to it. For most users to go there, the next big wave of crypto, digital assets adoption, blockchain adoption is not going to be something with the word coin or the word bit in the name of the company. Unlikely, I would suggest. It's going to be something with a very large, recognizable, maybe entertainment brand, one of the big four internet companies, banks. We've already seen it with Revolut's success in the space in the UK with crypto, driving their profitability last year. So I think that one of the big things that will drive the next big wave is it being associated, blockchain being associated with bigger brands. And the second one is use cases. And we're already beginning to see some use cases, because it's a fairly small subset of people that have got the risk appetite or the interest in investing in an asset that goes up or down 15% in a day. but people are really interested in kind of Web3 stuff in general, and the things that the thing that blockchain can power, whether that's play to earn gaming, whether it's cool metaverse experiences at their sports club, whether it's really immersive experience with brands that kind of tokenization and blockchain is powering. So I think, as we see, Alex mentioned cross-border payments, massive opportunity to disrupt. There's a number of kind of really good use cases for blockchain that are coming through that aren't just, does Bitcoin go up or down in price? So that's going to drive adoption. Real use cases, real world use cases that are well run and well governed, and are going to be around in 5 years' time if you put some money into them, or whatever else you want to use and you want to go with that brand. I think allied to that, being driven by big brands wanting to get into this space, and we know from the amount of companies we know that are building in this kind of down market to take advantage of the next run, that there's there's a huge amount of activity across all those kind of cohorts that I mentioned, whether it's big media conglomerates, tech companies, traditional FIs. They're kind of all working out what they're going to do in this space and get themselves set. So I think that will be it. And the third one is the one that's always been the same with blockchain, is making it usable. And that's still the ongoing challenge. How do you make it as usable, as usable as other stuff? But I think there's advance. All three of those areas, things are moving forward. Regulation is probably a fourth one, which helps give that kind of wrapper and makes that companies are being run properly. But yeah, definitely. We're definitely we're moving towards some proper and very interesting use cases. Fascinating one. I was at a conference the other week, looking at how blockchain's kind of uniquely suited to things like carbon credits, and then in the future nature credits. So, providing transparency of data around this emerging nature credit space. And that's something which everybody can probably, which will be super interesting for retail and institutional investors. The only way of doing that at scale is through blockchain. So as you get these use cases which really suit, and as we get more used to tokenizing real world stuff, you'll get more and more people into the space, and they won't actually care that it's on blockchain, because no one actually, apart from a subset of like quite odd people on Twitter, no one actually cares what platform something on. They just want it to work properly and to do what it says it's going to do.
Makes sense. I guess the last question I have, and I think it'd be good if all of you answered once. It's kind of something we do at the end of every session. What advice would you give to fintech entrepreneurs who want to succeed in this competitive, changing space? Ali, do you want to start?
I sometimes get sort of these comments from people who are passionate about fintech but don't know what to build, saying like, oh, all the low hanging fruit has been taken, like all the neobanks have been built, all the money, whatever, remittances, all these things. I don't know. Our world is constantly evolving, and as Nick has been talking about, sort of the underlying technologies are actually changing for the first time in a really long time right now, and I think there's a ton of opportunity to sort of build the new products for the right use cases using these technologies. And I also think just take a step back, think always big about what the big trends are in the world and what's changing from a macro perspective and how that impacts your micro market wherever you are, whether it's geographic or product or sector, and the intersection of how that can change with new technologies. So I think the opportunities are limitless always.
Fantastic. Shamir, do you?
I think I'm in danger of just repeating myself here. I think my advice would be track every metric, be really clear on what you're putting in front of your audience, and just be mindful of keeping an eye on the market as much as your product. Fantastic.
Yeah, agree with everything everyone said. I'd probably just add in from the founder perspective at the moment is, I think these times like this are moments of great opportunity, but they do require a significant amount of one, resilience, and two, ability to kind of observe the macro and feed that into your business plan. So I think it's about personally building your own personal resilience and understanding that these are times of which massive opportunities will come, but it is hard. It's hard work at the moment. It's harder. Every deal, a deal that was taking 3 months will take 6 months. A big client win that would take 6 months is taking a year. That all of this we know will change quite quickly. Hopefully it changes pretty quickly at the start of 2024 and moves forward quickly at the moment. But these are kind of inertia filled times to be doing business broadly at the moment. So, just calibrate, don't burn money too quickly, burn it at the right rate, be aware it's going to be a lot harder to raise more money than you think it was, or certainly there was before when you do, be cognizant that valuations have changed, that they'll move upwards. And, I just think be doing this, what everybody's talking about is taking that kind of long and short term view at the same time. You've got to be able to do the 100,000 foot and the 1 millimeter view in often within a few seconds at the same time to do that. And then finally, just make sure you're not trying to do it all yourself and surround yourself with really good people. No suicide missions for founders at the moment. Just make sure you've got other good people who can take the load off as well as you're working through these challenging times.
Thank you. Well, I would like to thank the three of you for your time today. It was great having you guys on board. Yeah, thank you very much for your time.
So thanks,
Cheers,
Simon.
guys. Thanks, Hugo.
Cheers.
So thank you and welcome back to today's last session of Emergence Global. I'm very excited to welcome you to our SaaS panel this evening. We are joined by four amazing and brilliant people. Eva Dobrozanska, Head of Distribution at True Altitude. Roy Tuve, CEO at Vertis. Josef Levenstein, CMO at Golden Section. And Darko Butina, General Partner at the fund. Welcome, guys.
Hello.
Hello.
Thank you.
Would you mind introducing yourselves? Maybe Eva, if you can go first.
Yeah, sure. So yeah, as kindly introduced by yourself, I'm with True Altitude. We are an investment firm and advisory helping early stage startups prepare for fundraising, fundraise better, and get more investable. We in the last year or so, we essentially help companies raise better. We spoke with over 400 VCs across the globe, and to each and every one of them, we were also asking questions of what do they look for in today's market? How does the investment landscape look for them, and what early stage startups should be doing in order to get the check in from them sooner? And this is essentially all the learnings and all the lessons that we want to be able to give to our clients, and help them target better, connect better, follow up on investors better to create some more efficiencies in the landscape essentially.
Thank you. Roy, do you want to go next?
Yeah, sure. Hi, I'm Roy Tuve. I run Vertis. We provide a tech-enabled service that helps businesses, usually tech startups and scale-ups, but also very large global companies, manage and optimize all of their software spend. So we give them a platform where they can track all of their subscriptions, track their usage and monitor what they're doing there, but also a team of negotiators that work on their behalf to deliver better outcomes. So we found in the last few years, obviously, where capital was very cheap, a lot of companies were buying a tremendous number of these tools, and in aggregate, it's a very expensive kind of line item for businesses. So we're helping them kind of deliver efficiencies. On a personal note, this is my third company. So the last 20 years, I was running two separate cyber businesses out of London and the US. And this is a relatively new company. We've been operational just a couple of years at Vertis.
Great, thank you very much for that. Josef?
Hey, everyone. My name is Josef Levenstein. I'm the Chief Marketing Officer at Golden Section. We are a Houston-based venture capital fund that invests in early-stage B2B SaaS and enterprise software companies. My experience, my career has been in B2B SaaS, mainly in the fintech space, and transitioned over to the venture capital side about 2 years ago, and helping our organization build brand awareness, but also make it as easy as possible for the right types of founders to find us so we can invest in them.
Great, finally. And finally, Darko, please.
So yeah, I run a smaller venture capital fund called The Fund. We are basically investing in European startups across Europe. So really from quite different countries, focused on B2B startups that are powered by software. We basically bring with us and behind us stand quite a lot of investors with lots of entrepreneurial experiences. Also myself, I've been on the side of the startups. I've managed also a bit larger companies with up to 500 million revenues and everything in between. So basically that's what we try to bring to the table and help our portfolio startups succeed.
Thank you very much. And perhaps just staying with you, Darko, what are some of the most exciting SaaS startups or trends that you're currently following or that you're seeing, and why do you find them compelling?
So basically, for example, if I look at our portfolio, the startups that are really, one startup, for example, from UK called Datadot, kind of ticks all the boxes. Now, why? Because on one side, and I'll use the current buzzwords of AI and ML, they do use fancy algorithms to improve their software. But what they do is basically they help to detect burnout, especially for software developers. And they do that practically automatically, which means just by analyzing interactions in various platforms or activities in various platforms and so forth. And I do believe that that's basically the hallmark of great startups that are starting to pop up, which means that basic startups that produce solutions that work in the background and improve the environment in which then the people work. And that's basically the theme that I do really and firmly believe, which is going to just gain on importance currently with the whole AI and ML trend. I think you can see that also in the media. But I really believe that there's going to be kind of not just a small change, but quite a huge leap in that respect. So that's probably the one thing that I would really point out.
Okay, great. And yeah, okay. And Eva, do you have a similar thing, or do you find something else in the SaaS startups perhaps is more compelling?
So it really depends. I think looking at the industry as a whole, what's happening now is that a lot of the SaaS companies are readjusting to slower growth rates. So after the record high 2021, everything's down now. Everything's down by about 60 to even 80%. And after the records in 2021 and then a slowdown last year, it is a much tougher environment. But that's because a lot of the SaaS companies are not hitting the growth KPIs that they had set in the up market. So I think the big focus and a shift that should be happening now is to shift focus to profitability. And I think, yeah, if I am to think of SaaS companies that are most backable, that would be the one who can trade growth rates for margin, and that can be a good thing.
Okay, great.
Yeah.
Joseph, coming to you.
Yeah, I agree pretty strongly with Darko. I mean, what we look for, and we've always looked for, is capital efficiency in the companies we invest in. But at the end of the day, B2B SaaS, we use a exoskeleton analogy where, the B2B SaaS solution that's being sold to a company, it can't be, a vitamin. It has to be a real solution to a pain point that they experience. What I think in the current environment and sort of going forward is that the number of employees may or may not change, but the desired output that a company has from their employees is going to change. And so having software that can really impact the productivity of an individual employee at a company is going to be really important for potential clients. And we've always looked at companies and forced pretty reasonable valuations even during the times of hype. And so because of that, our portfolio is actually still doing quite well because, to Eva's point, if the valuations were set at some expected growth rates that were based on the past market environment, then founders would have a really hard time meeting those today. And so we've been pretty pleased in the sense that we always had more reasonable valuations and more reasonable growth expectations. And especially in B2B SaaS, we think that's important. But one area that we do see that continues to get good traction, especially in North America, is marketplaces. And so, marketplaces that are coming in and solving major inefficiencies in more traditional, outdated industries. Mostly, think about like logistics or quality and supply chain types of areas. We're seeing a real opportunity for software companies to come in and help solve for those inefficiencies and those pain points and do it in a way that is really impactful to the bottom line of their customers and also has strong revenue opportunities. And so we see that as a space that's quite interesting, and we've seen a lot of growth opportunities there, even in the current environment.
Okay, thank you for that. And I guess for Roy, from the other perspective, from a founder's perspective, especially working in perhaps optimizing tech stack and SaaS for other companies, what are a lot of the SaaS platforms that you're seeing that are recurrent within SaaS companies? Is there one that sticks out more than others, or is it really across the board, the different kinds of companies that do different things?
Yeah, you could just imagine it's all the names that you recognize, he just mentioned Datadog, Salesforce last year, and all the big SaaS companies are used obviously very widely across all of our customer base. We do see quite a high concentration. So I think from the top 500 SaaS vendors, they typically have a kind of footprint around 80% in terms of all of the customers that we have. And I think the top 20 vendors represent north of 70% spend. And there's some very hefty packages, and some platforms like Salesforce end up being consolidated over time. So companies buy more and more features and capabilities, and sort of take some sort of sideline some SaaS tools and consolidate against others. So it's the same usual suspects, which is good from us because obviously we have a lot of experience working with a huge long tail of SaaS vendors globally. But the fact that we have repeated interactions with these same vendors makes us really have deep understanding of how they price, how they structure their models. And if you think about it from a buyer's perspective, so our customers, they may renew, at Atlassian or DocuSign or Box or whatever tool it is, or Marketo once a year. They may engage with them once every 2 years if they've got longer term commitment contracts. And we're engaging with these vendors multiple times a week. So we have really deep insights into how they work. And I can tell you, that's in terms of who they buy. But what's really interesting is what they end up using against these licenses. And that's really an interesting insight for us. So as part of our platform, customers can see in one place what they're utilizing against each license. And there's a lot of variance there. So a lot of companies end up over licensing tools. Sometimes they end up under licensing and get caught with overages. And sometimes they're overly optimistic about how quickly they're going to ramp up on a specific service. So I think that intelligence is something that's quite useful for a lot of customers as they navigate how to optimize spend and seek capital efficiency in this market environment where everybody's talking about profitability.
Definitely. That's definitely very interesting. I think another area that I wanted to speak about today is, the buzz around AI. So, and how that could probably how SaaS companies can start using that. So I saw that yesterday ChatGPT released their API. What impact do you think that and other AIs will have on SaaS startups and perhaps just the general SaaS ecosystem? Maybe Darko, if you want to take this.
I mean, I already mentioned before that I really do believe that that's going to bring quite a huge change. Not so much from SaaS perspective in the sense of the business model behind, so how do companies, startups price their services, but predominantly in what does the software actually do and what's then left to be done by humans, right? And that I think is something that, I mean, you can read a lot about it from different people. Like I said, I do believe that the change that this will bring will be quite large. I do not believe that any of us really understands all the implications that that's going to bring to the, let's call it everyday life, maybe not everyday life in the sense of how we live our life, but especially in the sense of what we actually do at work. And I think that that's going to have changes. For example, the whole schooling and education system will probably need to be overhauled because the way that it works currently will probably not fit the purpose at all anymore. Then the whole aspect of what's a commodity. So what do you expect that you get out of the box with anything? I mean, internet and computers themselves, they have done a lot of these things. For example, if you look at new companies, startups today, I mean, the day that they go out and present themselves to the public, they seem like there's an army of people behind that because their appearance is perfect, the page is perfect, and. But that's a result of everything that was done in the past years and decades. And with the whole AI and the ML aspect, and especially with the generative AI, I think that this is going to just, like I said, there's going to be sort of a leapfrog event. Now, the opening of the AI, the ChatGPT offered, and obviously also other contenders in the space are offering or will offer, will help to push that forward, right? Because everybody's going to be start to use that, and we're going to see those use cases. Next to that, and that's my last point, is that it's going to become even more important what kind of data you hold and generate. So privacy as such, will continue to kind of, let's call that, expand, right? So I do believe that privacy laws will become even harsher and. Now, why? Because the data is the basis for all the algorithms in the AI/ML arena. If you hold the right data, your algorithms can work better. And that generation and capture of that data will become even more important than it is today. So I think that that's kind of a mix that we will see.
Okay, thank you very much. I guess it's kind of what Joseph talked about maybe earlier in a way, in some, people working less, no, not working less, hiring less people, or but more output. I guess AI will have a significant impact on providing more output. Just, at my small level, at my small scale, I increased productivity last month of January by 30 hours just by using it. So that was really cool, and that was just in its nascent form, at least what the consumer gets in its nascent form.
Just one.
Are you saying, Hugo, that you invited me to this panel using ChatGPT on email? Is that what you're telling me?
No, not quite. No, not quite. However, some of the questions
That could have worked. Yeah.
But yeah, I think sorry.
The services aspect is going to also become more important.
Yeah.
So that's one part where human to human interaction kind of really comes up front and central. So I think that we're going to see more of that, even though you would expect the other way around, because the software automates everything. But I think that we're going to also see much more of that than we did in the past, to be honest.
Yeah. Okay.
I also think from a competitive perspective, AI is such a huge major shift in technology that it's going to impact almost every single startup, if not every single one of them. Because if you won't be using some AI capabilities, chances are your competitors will. And that's how you might start to lag behind. So if we're talking data analysis, if you're using advanced AI, you can analyze more of that data. You can do it faster. You get insights to larger volumes of data, and you can get ahead. You can improve your customer experience with AI chatbots and so on. It's spilling out everywhere. Not just ChatGPT, but like I use Notion to do all of my to-do list and take notes. I've just opened it today after the update, and there's an AI function. You can just press space and ask the AI to write now, which is huge. And then I think Microsoft's browser Edge is actually releasing a feature where you will be able to upload a PDF and ask the AI to either summarize the entire PDF for you or do other things, which is huge. So I think especially for SaaS startups, they will be able to do what they do much, much, much faster.
Cool. So I guess moving on to the next question, it's what do you think are, I guess, Joseph, you can answer this first. What do you think are the key factors that differentiate successful SaaS disruptors from those that struggle to gain traction in the market?
So, to focus on enterprise software and B2B specifically, the biggest differentiators that we see are the level of expertise the founder has in the industry that they're looking to solve for. And this sort of goes back to like the human element, right? When we look at potential portfolio companies, and we're investing in pre-seed, seed, and Series A. So these are very early on types of companies. We really spend a lot of time looking at the founder and understanding how deep their expertise in the space that they're looking to solve for actually is. And so whether it's someone who had a services business that had sort of pieced together a bunch of different workflows and pieces of software to help them do their work, and then realize that this is actually something that they can package up and sell to other, similar service companies to their own, or someone who's been in the industry for a long time. When they come to the table with that familiarity of the industry that they're working in, and with the problems and the pain points and the existing solutions and their shortcomings, they're able to come up with a product that can be truly disruptive in the space that they're operating in. And, you know, like I said, sort of more traditional industrial spaces are one of those areas that we see that to be very frequent, where someone has pieced together Google Sheets and some forms and a bunch of different workflows on different systems, and they say, well, actually, this should be all in one. So that's one area. That I think the disruption is both, there's an opportunity for that disruption, and I think there's a real need for it as well, because the pain is real for the people that are trying to manage all these systems together. The other side, which sort of patches onto that same concept, is you know, we had a lot of point solutions that came out in the last few years in B2B SaaS, right? And, you know, sort of leaning into one of our portfolio companies that works in the hospitality space, you have restaurants that they have, you know, a medium-sized restaurant may have anywhere from 10 to 40 different pieces of software that they're using to manage the restaurant business, right? They have their accounting software, and they have their shift work, and they have, you know, their remote, their delivery service, and they have their point of sale service. And those different solutions maybe see to each other through some APIs or some sort of integrations, but there's an opportunity for like operating systems in these different verticals that are an all-in-one solution, but also an all-in-one solution, which in the past, these all-in-one solutions didn't do that great of a job. But now we see a lot of founders that are putting together what they call, you know, a restaurant operating system. And the restaurant operating system means that now the owner of the restaurant too is not, you know, necessarily even a business person. They may be a chef, doesn't have to go and find all these different solutions and different pieces of software and try to consolidate all the activity and information. They have one piece of software that essentially is their operating system for running their restaurant. And, you know, I feel like, Roy, you would probably appreciate this, because now all of a sudden you go from negotiating with 20 to, again, like literally, I was shocked, but literally a restaurant will have 10 to 40 different pieces of software that they're using to run their business. So now you go from having to negotiate with 10 to 40 different vendors to one vendor who is able to provide you all the solutions. So I think those are two things we look at: the expertise of the founder, their understanding of the industry that they're trying to build a solution for, their experience and background in that space, and then also this opportunity to really move away from having a variety of different pieces of software to run a business and have one strong operating system that does everything really well.
So focusing on the niche then, like developing an all-in-one system for specific niches.
I mean, and these are broader niches, right? Restaurants,
Yeah.
I mean, I guess you could say it's a niche, but yeah.
Verticals, maybe verticals is a better word.
Verticals the verticals that need software to run their businesses efficiently, especially when they're running on tight margins. And again, like, you know, Roy probably feels the same, sees this as well. Like, these softwares add up, right? And when you're already operating a very tight margin business like a restaurant or many other businesses, that's not okay from a business success perspective. So the operating system doesn't just come in and solve the pain point, but also has a real impact on their bottom line.
Okay, great. I guess now for Eva, how would you assess the competitive landscape in the SaaS industry, and how would you advise perhaps portfolio companies or other companies to stay ahead of that curve?
Yeah, so I think it's become quite saturated now when it comes to SaaS, and it's becoming harder and harder for companies to, you know, find their gap in the market and actually grow in it. And for, especially if they are looking to raise capital from the VCs, what the VCs are looking for is a high growth sector that is only at the beginning of its inflection point of the growth and curve. So finding that right gap in the market and that spot in which there is a substantial amount left for growing is very important. And one of the things that I always say to our portfolio companies and to our clients as well is that I think one of the biggest red flags would be to go into a pitch meeting, and when talking about competition would be to say we have no competition. I think you always have competitors. You always do. There's always other people in your space. Maybe they are less direct competitors, but still indirect, and you have to look them up. You have to look up what they're doing. And yeah, my advice would be here to essentially do your research. And the other one goes back to what I said earlier with the slower growth. This is okay as long as they can trade it for for the profitability, and finding the right product market fit in a down market is a bigger challenge, but then also a much better testament to your product market fit if you actually find it in a slower market, because that's when also you can tell that your product is a need to have rather than a nice to have, which is what I've seen a lot of the investors, like focusing on these days. And yeah, overall, it's a tougher environment. And I think when it comes to SaaS, what I've seen is that I've seen from the conversations that I've been having with VCs and investors is that B2C seems to be struggling more because that's relying on us consumers. And in the down market, that could be tougher to retain them, tougher to upsell to. Burn rates can be higher. And that is all the metrics that the SaaS startups should be looking at in order to get better. So essentially, overall focus on efficiency.
Great. And Roy, on the other hand, you have founded and grown 3 successful companies. From a founder's perspective, how do you assess the competitive landscape, and how do you position yourself differently to address the market?
Yeah, well, each one is specific, but I can answer that question directly, but I can also weave in a little bit based on like the previous kind of 2 responses. So, you said what makes SaaS, what makes good SaaS or what makes it interesting. And so we had 3 SaaS companies. And it's really powerful when, as everybody said, if the vertical's really difficult or the existing incumbents are slow and the software's crappy and all of those things. But what makes it super powerful is when you have something that makes sense to be done as SaaS that can't be replicated in-house. So in our first cyber company, we were the first to identify threats, and then all of our customers globally auto benefited from it because they're all, routing their traffic through us. Similarly, with our current business, we have benchmarking insight data from all of our customers. So because we're running as a SaaS and we're seeing what everybody's buying, what everybody's choosing, we have amazing data. We can tell you if you want to pick an HR software based on integrating with the specifics of your stack, what people are doing. 22% are buying Bamboo, or for ERP, 36% are buying NetSuite and what they're paying. And crucially, what's happening in the last year, like the trend. 3% of customers are moving from one platform to another platform. 6% of customers are consolidating away from Marketo into whatever other tool. And so I think SaaS becomes really, really powerful when it can do things and bring value to customers that you just can't recreate with on-point solutions. And interestingly, as Eva said, the market gets increasingly saturated, but you get byproducts. So if you think about our business today, we exist partly because of so much software that's been bought and sold, right, in recent years. And it's only once that's happened that a lot of the pain has been introduced, which we come to solve. So I think it's a little bit never ending. There are always pockets, and obviously, it's difficult to create the new Salesforce, but there are always pockets of opportunity based on the way that the market and the dynamics are shifting. And we definitely found that. In terms of, answering your question directly. So, the interesting question that we have, and again, based on what Eva was saying around efficiency, is how do we approach growing in our market in an environment that's changed, where people are seeking profitability, but yet we're not in a mature category. And so once you're in a mature category, it's quite easy. You've achieved the growth, you've got the position, and you now need to eke out profitability, and you make the trade and the balance of exactly where you need to hit. But when you're in a land grab market that's kind of exploding, which is where we are, where we're growing incredibly fast, it's much more difficult and tricky, I think, to assess where to draw the line and the balance. So we just have to monitor and have a lot of discipline in terms of how we're looking at our unit economics and the metrics of our business, and not to make big investments that we won't get the data from over a long time. But we're of the posture that we just need to continue to grow very, very quickly. And that's the position that we're in today. But again, it's an interesting dynamic because the environment has obviously deeply shifted.
Cool. Does anyone else have anything to add to that?
Maybe just from my side, just to add to everybody's opinion, we invest predominantly into really very, very, very early stage companies. And there, to be honest, the first metric that startup founders need to look at is to generate first revenues. Not necessarily grow fast, but generate first revenues, because that means that somebody, a customer, has paid for the service that you provide. the solution that you provide, which basically also enables you to improve that solution and with that really solve the issue and the problem. And that basically brings you to the second phase where the growth is an imperative, especially for startups and any kind of startup that takes outside money from venture capital investors, angels, and so forth. Growth is paramount. And to be honest, investors do expect startups to lose money. So profitability is not at the forefront. Now, that does not mean that you should not really pay attention to your position, like Roy described. I think that one notion that basically really differentiates good founders from the rest, or good startups with the good founders from the rest, is they do plan their cash flow, which means that they keep their burn rates under control. They understand and know till when they can afford to continue to invest, and when they need either additional capital or they need to take other measures to potentially basically prolong the life of the company. But for startups, I mean, growth is the name of the game. You need to grow, you need to grab additional market share, and. If you stop doing that, you suddenly fall out of the category. And that brings other issues, to be honest. I mean, your valuation cannot be the one that your investors have actually admitted to you or invested the money at in your company, because if you're not a growth case, it's a completely different ball game. Then you look at actually achieved CF and that's not the same. So I think that kind of you need to navigate between all of those. But as a startup, you should still grow. And also in this kind of market, I mean, yes, do save money or do pay attention to the burn rate. Don't overspend, be frugal about it. But ultimately still invest.
Yeah, okay.
Yeah,
Could
and
you,
I'll just
yeah, go for it.
So one other thing, I mentioned this earlier, the reason when we came back to founders during 2020 and 2021 with much more conservative valuations than they were seeking, and they accepted our investment, was because the way we presented it to them was, at the end of the day, if you're getting a really high valuation on your company, your investors are going to expect you to justify that with revenue growth and eventually profitability. And so while everyone was in the market at that point in time writing larger checks and on these high valuations, and we refused to, the founders that aligned with that point of view now are in a very different position, because in B2B SaaS, especially, the growth rates should be more of like a stable, sustainable, not necessarily hockey stick growth. Everyone loves hockey stick growth. Everyone loves unicorns for sure. But in reality, in B2B SaaS, it's a long sales cycle. You're selling into places that take a really long time to make decisions. Usually you're taking a beachhead, so you're getting a small contract that you're going to grow over time. Your account management and client success is critical to that. And so if you're coming to investors with a really high valuation, then they're going to expect that to be justified in your performance. If you take a more reasonable valuation, raise less money, maintain more equity as a founder also, it just gives you more options, and it also is more aligned with the way B2B SaaS companies grow. And so we've always believed in that. And we've seen both the mistakes of raising too much money firsthand and in other scenarios, but also we're seeing now, especially in this environment where these B2B SaaS companies are able to continue to grow their revenue as they should, moving towards profitability, but they're not chasing some crazy valuation, or they're not trying to justify some crazy valuation that they had applied, and that really is benefiting them. And from our perspective, it's great because from an investor's perspective, we're seeing really good performance from that.
That I'll just add, that echoes true for so many of the cases that I've seen, and something that we told a lot of our clients is that if you set your valuation pretty high for where you are in your round, you also have to remember that you're setting effectively a high benchmark for yourself for your next raise. So when you get to your Series A, jump over that, Series B, jump over that, and the higher you go, the more you will need to deliver. So I think it's a case of looking not just at your current race and going as big as you can, but look at your future ones as well.
Okay, nice. Darko, coming back to what you said earlier, could you perhaps share an example of grow SaaS company you have previously invested in?
I mean, one such company is Cognizant, one of the highest growth startups in the UK, doing basically lead discovery, lead generation, where I actually led the first institutional round with the company I was in previously. So, for example, Cognizant for the last few years is constantly delivering on its promises, very ambitious growth rates, but constantly delivering. Now, obviously, Cognizant is, for example, competing in a market that's relatively saturated. So it's not exactly a completely nascent market. It's a relatively mature market. So lots of competitors and so forth. But where they differ is on one side, their approach towards data, and the other side where they really differ is that they really eat what they cook. So they really have a great sales engine behind, and they have built, from my perspective, a perfect sales engine for a B2B company in almost any environment. And because of that sales engine gives them the repeatability, the scalability that you need to have if you want to grow really fast. And that's basically the reason why they are able to hit their goals and basically grow constantly.
Okay, great. Eva, so how are SaaS startups nowadays? Is that an area that is still, would you say, are still hot for investors, considering that the downturn maybe we've had in 2022 and the start of this year?
Yeah, so I think that's basically going back to the point I said in the beginning. I think still hot, definitely, and will be even more so, as you said earlier, AI is transforming the industry. And to echo what Roy said earlier as well, as we build more SaaS and AI capabilities, there is going to be more new problems to be addressed. So I think, we're going to see continued development in this space. But I think what's happening right now is that we're somewhat still in this after COVID hangover, so to say, after the crazy high valuations that then, led us to a down market. And also no one could have predicted the war in Ukraine. No one could have predicted the cost and energy living crisis. So again, to reiterate what I said earlier, those SaaS startups that are starting right now, if they can find their product market fit, if they can survive in such a harsh environment, then yes, it will be a very hot area to invest in. It's just going to be down to the investor's savviness and being open-minded and being very smart about their investments to find those future unicorns. I'm always saying, and I've done so much research on this, that some of the best unicorns were born in the times of crisis. After the last 2008 and 9, that was around that time when we've had Uber, Slack, Snapchat as well, I think, develop and so on. That was all after the financial crisis. Now it's probably going to be the same case as we are in that doorstep into a new AI era. This is where, I think with SaaS, I sort of stop looking at it as an industry. I sort of start to see it as an underlying model that permeates through all sectors and all industries. So it's becoming more ubiquitous. And in that sense, it will be definitely the area to invest in. What we will need to just look at is what market are they in? Is there a huge potential for growth? And are they doing it in the right way? Are they utilizing all the capabilities that are out there? Hint AI, I really like AI. And then have they found their niche and their gap in the market to actually have that space for growth?
Yeah, I was speaking to Patrick Driscoll, who's based out the venture capital firm in San Francisco last week. He was telling me that a lot of people have been laid off, obviously, with the Meta, all the big all the big companies. And he went to a conference where everyone who was laid off was there. And all they were talking about was their crazy ideas for AI startups. So it's exactly that,
yeah.
you know, a lot of people are in this
there's
time.
there's a huge talent of pool, or huge pool of talent that suddenly has been freed up from those large corporations. And like, you know, like those people are not gonna, you know, like do nothing for too long. They're gonna get busy and they're gonna start, you know, like either forming startups or joining other companies. So yeah, I think yeah, we will see like a huge up market very soon.
Definitely. I guess switching a bit the conversation back to you, Roy, in terms of have you know, with your companies, have you had to adapt your go-to-market or proposition in light of the current environment for B2B SaaS?
Yeah, not really, because we're in the sort of saving money mode for companies and optimization, which is obviously hitting like the curve today, and is top of mind for a lot of companies. I think that we're still expanding globally, so we have presence in all like the kind of major theaters. I think in terms of the ICP, it's pretty much the same. But yeah, it's all born out of the core kind of proposition, which is one that's designed to deliver capital efficiency for businesses. And so I think that, you know, as we've kind of iterated our product offering and built up some kind of more capabilities in the underlying platform, we're just adjusting a little bit to the reality of what companies really care about. So what I would say is, if, you know, a year or 2 years ago, when we were engaging customers, they cared about like saving their time, and they cared about kind of reducing complexity, but they weren't as focused, frankly, on saving money. And in this environment, they're super focused on saving money. So we've had to adapt a little bit some of the controls and capabilities that they have in the platform to like demonstrate the cost savings as a higher priority than it was a year or 2 years ago. They're also very wary of making new investment decisions in software, which obviously is negative news for the climate of B2B SaaS startups that are looking to thrive and start. And so they're leaning on us to help them run RFP processes and be more selective and more educated in the kind of tools that they bring on board to their environment. And so that's something, again, that we've kind of prioritized in the product offering. So we've had to make some tweaks here and there based on a slight reprioritization of the core pain, which was, one, save me time, two, you know, reduce complexity, but now really kind of drive efficiencies for us. And, you know, Ava mentioned, you know, that B2B or SaaS for B2C is a problem. I can tell you SaaS for B2B is definitely a big problem, because the number of sort of what I would call incestuous sort of you buy my product, I buy your product type stuff that goes on in B2B SaaS is quite high. And I can tell you that a lot of those companies are going to have a lot of churn issues this year and downgrade issues and consolidation. We're right at the forefront of that, and we see exactly what's going on. So I think it's not like the easiest time for B2B SaaS companies to kind of scale. And obviously we're monitoring, if anyone hasn't seen it, I know it's a rival investor group, but Scale, who are not affiliated with our company, but Scale Venture Partners publish this report every quarter on the growth across their portfolio. They, you know, what's top decile performance, what's mid performance, quarter by quarter, so we can all see the trend lines, and we can all see how the growth rates of these B2B companies are being affected by the new environment and economy. It's kind of useful insight and useful benchmarking for us, because data gets really old very soon. You know, 2 years ago, a growth rate was X for top decile. Now it's something completely different. But I guess what I'm saying is it's a tough climate in B2B SaaS right now. There's going to be a lot of negative margin pressure on these businesses, and they're going to have outsized growth to kind of maintain like historic growth profiles. As we've all said, if they're still growing fast and maintaining, you know, margin profitability, it's fine, but it's going to be a little bit painful.
I think one feature that startups need to have is not only basically the not being nice to have, but really being a have to, so that people actually see the problems that are actually being solved with the solutions that the startups provide. But the one important feature is that startups need to deliver immediate value. If they solve an issue, solve a problem, and deliver immediate value, then the sales cycles and everything else can be fairly short. also in this environment, or even more so in this environment, because they provide immediate impact. So I think that any kind of issue or problem that the startup is trying to solve, they need to distill what part of that problem they can really solve immediately, so that they deliver the results. And with the delivery of results, either that's a saving or increasing productivity, increasing revenues, whatever. But if they can deliver that immediately, then they can also sell much faster.
Yeah, and I echo that. I don't want to like plug my business, but it's just like a fact, right? So I've never seen in my experience such a quick realization of value that's easily demonstrable to customers. It's basically the next time they renew a contract or buy something, which happens like on average, within a week or 2 weeks of our engagement, because you can imagine a company can have 80 or 100 SaaS tools, and they're going to be renewing like 2 or 3 a month minimum, even with longer term agreements. They're still buying things or moving across. And we can immediately show an impact. It's translatable, very easily tangible and read and measured by our company. And I always say, as it relates to cost saving initiatives, so I was running businesses for 20 years, we bought lots of tools. And every so often we were introduced, when we got to a certain scale, we were all looking for cost efficiencies. And we had, replace your data warehouse with a new one that's going to save you, X cents. But to do that undertaking and like rip out your data warehouse and pull a new one in and prioritize engineering resource from not building new features for top line growth is incredibly challenging. And in our environment here, there's none of that. They get a very pure, very clean, very quick ROI, and it's super powerful to have that kind of echo feedback model to the CFO. And also that's what gives you referenceability and referability through the community that you have. So it's a little bit of a plug for our business, but it's just a true fact that it's super, super powerful when you can demonstrate very quick ROI.
So thanks for that. But probably coming back to Joseph in terms of, we've talked about what they need to do. But Joseph, what mistakes do you most commonly see founders make when building their product and company?
For sure. So, the biggest and most common mistake that we see founders make is it's a combination of like this panic feature building, right? And so you have a product, it's in the market, you have some product market fit, you have some clients, and then one of your customers comes in and says, the worst case scenario is a prospective customer is like, yeah, I would buy this, but only if you had this switch. And, the founder turns around and is like, sure, no problem. And, starts to, turns around to if they have a full product team, goes back to the product manager and is like, fit this into the roadmap and creates a bunch of chaos in the product development side of their business for a prospective customer. And on the other side of it, existing customer, it's like, yeah, I'm thinking of canceling because you don't do X. And then the founder again turns around and runs to the product team and says, we got to build this feature right now. And that mistake has cascading effects because it creates chaos in the product development side of the business, which means that the roadmap gets disrupted and other things that were on track to be delivered don't get delivered because they get sidetracked by this new feature. Very often that feature is going to be built without proper BA and UX accountability because it's rushed, and then frequently is the result is anyway the customer churn, so they don't sign because at the end of the day that was sort of just an excuse. And so from a B2B SaaS and product perspective and from the founder perspective, that is a really common mistake that happens where they just try to sort of quickly add in a feature either that was never on the roadmap or prioritized outside of their existing plan. And when we look at capital efficiency, that creates a lot of capital inefficiency because again, resources aren't being utilized at the optimal levels. It creates a lot of discomfort amongst employees, and so your employees don't feel great. And that's just something that we see very often happen. And we work very hard to encourage our founders to stick to their roadmap, stick to the sprints that are not breaking sprints, and really just staying on track with building their product the way they planned it. And it takes a lot of discipline and a lot of confidence to do that. And there's no absolute rule, but that's certainly something that we try very hard to encourage founders to avoid. So that's one of the big mistakes that we see, and we try very hard to help people avoid. And we've experienced it firsthand as founders ourselves, where we've made that mistake and know what the consequence of that mistake can be.
Maybe just to add something to that, especially in Europe, what one can see is that the founders are usually too technical. What that means is basically they build the features because of the technology, not because of the client needs, which results in basically same things as Joseph mentioned, but even worse, the clients actually do not demand the features. So the products tend to be too perfect, too basically overdeveloped, and without really listening to the needs of the customers. And I think that that's especially for startups coming from all over Europe, something that it would be wise to improve. Obviously not falling into the trap that Joseph outlined, that you only listen to the customer, but don't develop features just from the tech perspective because you can.
Yeah, and that's a big part of why, like, when we talk to founders, and especially after we've invested in them, like, following having the discipline to stick to your agile methodology is so critical. But also, get your MVP out in a way that is runs right, and that's why having a strong foundation for the software is so critical. But it doesn't have to have every feature, and it doesn't have to be perfect. It has to be enough that you get someone to pay for it, and then you can start to build it out. And the way we see it is the best way for a capital efficient startup to run is that their R&D is being funded by revenue and not by venture capital dollars, because those dollars, from a founder's perspective, and this is putting yourself in the founder's shoes, are really expensive. You're giving up equity in your company. And if you burn through that money because you're building all these technical features that no one needs, you're going to need to raise more money and give up more equity and then rinse and repeat. And so when we look at it, we say, having a disciplined product development strategy, and we have a lot of expertise internally on helping them with that. We believe that that's really critical. And then focusing on building revenue, marketing, and sales, and really not spending your venture capital dollars on building software, and get to a point where you can fund the software development with the revenue that you're getting from the customers that are using your software.
Yeah. And to add on that just quickly, what I always tell founders is to also make it easy for your customers to submit feedback to you. So those forms should be easy to find, easy to fill in, easy to submit. And like, even from like a personal standpoint, I know that if I'm using a platform and I've got like an issue with something, but like I can't find a form of where to submit it, or it's too long, or the form will crash, I'm not going to refill it again. And that's a case of many users as well. So it needs to be like super easy to actually give feedback on an ongoing basis as well.
Okay. Well, I think, I had a question that was relating kind of all of what you guys have just said. With all of that,
by the way, that you didn't ask the one founder what mistakes founders make. You've obviously established that I don't make mistakes.
We all pitched in.
That was about to be the second question, but I was going to say, how important is customer feedback and user experience in the SaaS industry as a metric from an investor's perspective, and how is that balance? Where is that balance for innovation? Is it more so? Where is that balance? Do you listen more to customer feedback, or do you innovate more? What if anyone has anything to add to that, that'd be great.
I mean, our perspective on that is that UX, UI, and again, this sort of comes back to what I said earlier, right? Having a full stack product development team is what enables that. And so, if you think that just because it's business software, it doesn't have to provide a good user experience, then you're not going to get the traction that you want. And so, from our perspective, getting the UX, UI design done right and in an attractive way is important for building software. And so we certainly put an emphasis on that. In terms of the customer feedback, that still goes back into having a full stack product development team, which means you're getting feedback, you're collecting it, and you're not just letting corner cases or one-offs influence your product development decisions. So you definitely want to be collecting user feedback, client success and account management is critical in that, because Ava's point is right. There's forms, but also just conversations with the people actually using your software are going to be really informative. But you can't just take one piece of feedback and make a decision based on that. You need to be gathering it in a way that you can then feed it to your product manager and help them make a decision based on the volume and based on the importance of it. And then again, having a business analyst that writes the business use case for that. So absolutely, getting the feedback is important, but also knowing how to process that feedback is important, and having a well-designed piece of software is pretty critical, even though it's for businesses.
Cool.
But
go for it, Darko.
From the KPI perspective, as an investor, you don't exactly look at all those details, but where you do see the impact of all that, right, is growth itself. So revenues that you continue to generate, higher conversion rates in the whole sales funnel, because the more you improve the product, the easier it is to sell, conversion rates go up, and you're able to upsell more. So you get a better unit economics and. So for all those KPIs, basically all of that development, the right development at the right time, basically comes into place. So I would say that those KPIs are where you actually see the impact, but obviously you need to do the legwork on the tech side, right? And on the feedback side, like Joseph and Eva previously mentioned.
Okay. I guess now it comes to the question that Roy wanted. Roy, as a SaaS founder, what are some of the biggest challenges you faced in building and scaling your company? And how did you overcome them?
Yeah, no, I was only joking, by the way.
I know.
So look, I think a lot of things that have been said are exactly true. We all had the experience. We signed up GE in our first company, and they kind of messed up our roadmap and all of those things. But I keep telling the team, and I'm popular around here, that it's a lot to do with what you don't do. And what's the challenge you have when you have a very promising company like we do, and lots of customers, they keep giving you lots of things that you can do. And we independently have great ideas of things that we can do every single day. And these are not like crap. When you have a nice company, they're not sort of crap ideas that has minimal features. They're like really interesting and exciting. But you have to have a tremendous discipline not to do them, or to do them in the right timing and be very kind of measured. So obviously we do this because we like to create, and we value ourselves and consider ourselves as innovators. And we've pioneered a couple of categories. So we have no shortage of vision and ideas. But deciding what not to do is just as important as deciding what to do. And I keep reminding my team every sort of day, look at the number, it's like growing pretty fast. And some of these ideas require retooling of our go-to-market, a new challenge, a new territory, things that we don't understand right now, and introduce distraction to the team. And it's a balance like everything else, growth and profitability. It's the same thing. You want to innovate, you want to keep showing to the market and to your customers that you're adding additional value to them over time. But if you do it at the expense of execution, add too much complexity, introduce challenges and changes in the way that you work, it can be very damaging for your company. So I'm a lot of the time a person says, amazing idea, genuinely believe it's an amazing idea, genuinely believe we could do a lot with that, but we're not going to do it. No time soon. And so that's the kind of mantra that we live by in a bunch of scenarios.
Okay, great. I guess this is our last question. It's I ask it on every session. So what's your best piece of advice for founders of product market fit who are looking to launch their software? Maybe Darko, you can start.
Get the first customer, and then get the second one and the third one, and so forth. I mean, the customers are basically what defines your product market fit. So also, if you are in B2B space powered by software, I mean, it's software, which means MVP. You can do that. Narrow down the features that you need for the MVP, go out in the market, test, have the first pilot customer, and the second one and the third one, have the first paying customer, and. I mean, that's the only way how you can get to a proper product market fit. Don't build the product in a garage for years and years, because, I mean, you're selling in B2B SaaS space. So if you need to be out in the market. That's probably the best piece of advice that I can give.
Eva?
I was just thinking, so I would add on to that, to what I said previously as well. Do a thorough research on what are your competitors doing. So find your competitors, do a research on them, and see who they sell to, who sticks with them if you can, what feedback are they receiving if it's public, and that can be a huge help, not only to define your gap in the market that you want to address, but sort of like, like put like a boundary of where your product market fit might not be because the competitors are already there.
Great. Roy?
Don't listen to what customers tell you, listen to what they're spending money on. So a lot of times I hear, they love this thing. Now, I haven't monetized them, but I will. It's great. I'm like, just follow the dollars, In times that customers don't like to say bad things, but when they park with 50K or 100K, then they really do think it's valuable.
Completely agree.
Joseph?
Yeah, so I agree with what everyone said. So I'll throw in a little bit of a marketing twist. And this is something that I share with our portfolio companies as well, which is think about your brand and building brand awareness, even in the early days. And the reason I say that is because being out in the market and having the product out in the market obviously is critical, but that takes time. And so in the meantime, before you do that, think about creative ways that you can create brand awareness for your company. Ideally, you may have an MVP or some sort of demo that you can share for any inbound inquiries that you get, but thinking about brand awareness, which is basically defining your market, defining your audience, and then fortunately in today's world, without spending that much money, you can start running some campaigns that are really just, and this is really crucial for founders to understand, that running these brand awareness campaigns doesn't mean that you're going to start getting inbound leads. That's not what the point of building a brand awareness or running brand awareness campaigns is. It's really about getting out in front of your potential customers before you're coming to them and selling to them, because their subconscious is going to remember seeing your ad on LinkedIn or seeing, something on Google related to your company and the solution you provide. Maybe they even click through and poke around your website a bit, which means that you've cookied them, and that also helps in some ways. But building that brand awareness even before you're actively selling into those markets is really important, because then when you do start actively selling into the market, you have potentially people that you can engage with that are going to be somewhat familiar with your name, somewhat familiar with your company, somewhat familiar with what you're doing. And it's going to make that sales process a little bit easier. And the mistake that I see a lot of founders have made, both that I've been a part of or in the side of the portfolio, is that they look at marketing as a lead generation tool right off the bat. And the reality is that before you start generating leads, you really want to think about how you're building awareness for your brand and getting information out in front of your target audience, even if you're not actively or immediately selling into them at that point in time. So as you're building your product, spend a few $100s a month running some ad campaigns on LinkedIn, targeting your potential customers, so that when you are ready to start sell that product to them, they may be familiar with your brand, or subconsciously they've seen it and they're like, oh, this is something that I'm familiar with. I don't know exactly why, but they may be a little bit more inclined to engage with you when you do reach out to them.
Okay. Well, thank you all very much for joining today's session, and for everyone watching. Feel free to network with everyone on the networking zone. If you're watching from YouTube, please find the link in the description. I would like to thank the four of you for joining today's call. It was really great.
Thank you, Hugo.
Awesome, great to be here.